Okay, so these three questions are interconnected. So what I'm going to do is this question says, what is the total variance? And then what is the price and efficiency variance? The total variance is automatically calculated when we do the price and efficiency variances. So I'm jumping into here and it says use the data from exercise 10.10. I'm going to combine this together. So now the very first thing you want to always do when you are going to do variance analysis, and remember, we've used standards for the whole year, then we're going to compare it to what actually happened, and we're going to evaluate management. So the very first thing we want to do is we want to have our standards, direct material amount, or whatever matrix, and direct material cost per matrix. So this is the direct material amount, and I'm going to put matrix. And the reason I'm saying matrix is you'll understand this in a second. I can then do direct labor amount, and this is going to be direct labor hours. And then I can do direct labor cost per hour. Okay, so that's the matrix. And the reason I say direct material amount matrix is because sometimes we use grams, sometimes we use linear foot, sometimes we use liters, sometimes we use whatever, right? There's different matrix that we use, and we need to discover what that is. And then what we want to put here is we want to put the standard, and we want to put the actual. So I always do this first before I start reading the question, and I fill in the blanks with the information that I have. Over here, I'm going to move this over here. I'm going to put question 10 up here. We're only going to do it for direct materials because this is the material variances. So it says this company produces high quality leather belts. The company uses a standard cost system and has set the following standards for materials and labors. So leather, they use strips. So this is what I'm talking about, right? Direct material strips, the matrix that we're using here, and the direct material cost per strip. That's the matrix. When we look at direct labor matrix, it's always hours. But when it's direct material, it can be strips, it can be grams, it can be pounds, it can be ounces, it can be linear feet, it can be meters, whatever it is, that's the matrix that we're using. So they said standard is 3 strips. Okay. And the standard cost per strip is $4. It also says for direct labor, we need 0.75 of a direct labor hour, and the cost per hour is $12. These are all the standards. Now here they show us the total standard cost, but we're okay with not knowing that. Instead, what we need is we need the standards and we need the actuals. So I now have the standards. I'm going to give it one space in between here because I want to put the word strips. This is per strip. This is hours, and this is per hour. During the year, they produce 92,000 belts. So this is actual production. Actual production is 92,000 belts. Actual leather purchased was 287,500 strips at $3.60 each. So now let's pause. We want the actual per strip. The actual per strip is $3.60. Now we've got that, but we need to know how many strips they used per belt. Now we know how many total strips there were, 287,500, but that's total for all the belts they made. If I divide this by the number of belts I actually made, which is 92,000, it should tell me how many strips I used. I used 3.125 strips. And it cost me $3.60 per strip. So now I've got my actual information. I can move on to the direct labor actual information. There were no beginning or ending inventories of leather. This is what we always tell you. Actual direct labor was 78,200 hours at $12.50 per hour. So we know that they spent $12.50 per hour. So it's per hour again. And I know the total number of hours, but I don't know how many hours it was per belt. So I can take the 78,200, divide it by the 92,000 belts that we actually produced, and it was 0.85 hours per belt. So now I've got my standards, and I've got my actuals, and I've got my actual production. Now I can calculate my variances. Break down the total variance for materials into the price variance and usage variance using the column and formula approach. I'm not going to use the column and formula approach. First of all, it's really hard to memorize. So it's a lot easier using what I call the diamond approach, which is what I showed in the videos. So in the diamond approach, we do the direct material price variance, and we do the direct material efficiency, usage variance. They mean the exact same thing. So I'm going to say usage, but then I'm going to put in brackets efficiency. How efficient were we in using the leather strips? Variance. So they call it different words, but we know it's actually the exact same thing. I'm going to center all of these. There we go. So in the diamond approach, it's a nice, easy way to do it. You can do it quickly on paper during an exam if you wanted to. We're going to draw a diamond, and I'm just going to keep drawing a diamond, and then I'm going to copy it over. And I'm going to do the bottom part of the diamond too. I'm not going to match them because I need the space. So there we go. I'm going to keep doing this. Here we go. There we are. There, we've got the diamond. Going to continue. We're going to do another half diamond right down here. That's going to get us our number. And the number in between this, it's going to be our variance. So I'm going to insert a arrow. Alphabet goes from A all the way to Z. So we're going to use that understanding of our alphabet. So we always use that same structure, right? And this is a price variance. So this is going to be the price. So this is my actual price. A comes before S. This is going to be my standard price. And then this is going to be my actual quantity. Okay. Oh, I forgot to, let me back up. I forgot to copy this first. Paste. Yes. Okay, so remember I said A to Z. So this is the price variance. So this is going to be the actual price and the standard price, right? So we go from A to S. Way down here is my actual quantity. Now, the nice thing is, I'm going to put in an arrow, my actual quantity, I simply transfer up here. And don't forget, this is the usage, efficiency, quantity variance, whatever you want to call it. That's what I need. I'm just going to copy this actual quantity right here. I'm also going to take my standard price right here, and I'm going to put it down here. So I'm just going to copy my standard price down here. So notice how nice it is because it's crisscross. Like it's so basic. And when you have to memorize all the formulas that they give you in the textbook, that's crazy. We don't need to memorize the formulas at all. So this is direct material usage. So we're talking about quantity. Now, this is where it gets a little complicated. This is standard quantity. Again, A to S, but standard quantity is calculated specially. So it's calculated as the actual units produced multiplied by the standard, I'm going to use short form, standard quantity per unit. Okay, so this is it. If we could fill out these blanks, then we're good to go. We're just going to do the multiplication. We're going to do the multiplication from here over to there. I'm going to do a multiplication from there over to here, multiplication from there to there, multiplication from there to there, and then I'm going to get the difference between these two numbers, and it's going to give me my variances. So rather than memorizing a whole bunch of information, I don't need to do that. Actual price for direct materials, right here. Standard price for direct materials, right here. Actual quantity. So what is the actual quantity that I ended up purchasing? I'm going to take that 3.125, and I'm going to multiply it by my actual output. So I'm going to put a little note here. Actual quantity is equal to actual units produced multiplied by the actual direct material used. That's what I'm calculating here. Okay, want to be super clear about it, moving over. So that's what I did, right? I took the number of strips actually used, multiplied it by the actual quantity. I'm going to take this number and I'm going to transfer it up here. I'm going to take the standard price and I'm going to transfer it down here. There we go. Now, remember I said actual units produced, 92,000, and I'm going to multiply that by what? The standard quantity per unit. Standard quantity per unit is 3 strips. So I'm going to do 3 strips. So this is going to get me my standard quantity, 92,000 multiplied by the 3 strips. If I produce 92,000, I should have used up 276,000 strips. And I'm just going to put the word strips here because this is strips. These are all strips, right? The matrix that we're using. So now I can actually do my multiplication. To do my multiplication, I just do the actual price multiplied by the actual quantity. So here we go. Actual price multiplied by the actual quantity. Standard price multiplied by the actual quantity. I take the difference between these two numbers. That ended up being negative. I don't want a negative number. So I'm going to take the bigger one, subtract the smaller one. And I want to be clear, this is dollars. Is this good for the company or bad for the company? And to know whether it's good for the company or bad for the company, I have to look inside the diamond. This is what we should have spent. This is what we did spend. Was this good for the company or bad for the company? It is good. So that is going to be favorable. And favorable is generally denoted as an F or an FAV. We now know that the direct material price variance is 115,000, favorable, which is good for the company. They saved money because they spent less per strip. So now we can do the same thing with this usage variance. We're going to do the exact same thing. So I'm going to take the number of strips and I'm going to multiply it by the standard. I'm going to take the number of strips we should have used and multiply it by the standard. I'm going to take the difference between these two. It is 46,000. Again, I'm going to take another box. I'm going to put it over here and I'm going to say to myself, okay, this is what I should have used. This is what I did use. Is this good for the company or bad? And you are correct. It is unfavorable. So unfavorable is usually just UF or U. So now we know that the direct material usage variance was unfavorable. Are we surprised about this? We spent less money per strip, but we used way more strips. It's possible that when we reduce the cost per strip, we reduce the quality of the strips. So we're ending up having to use way more because we've got a whole bunch of discards because they're not good strips. So you can see the connection between the direct material price variance and the direct material usage variance in this case. Now, just remember, we're going back to this question and they wanted the total variance. Can we calculate the total variance from the information that we did? And the answer is yes, we can. The total variance, total direct material variance, is equal to the direct material price variance plus the direct material usage, also called efficiency variance. So all we need to do is add these two things together. Now, if one is unfavorable and one is favorable, we subtract them. So in this case, we've got favorable subtract unfavorable. It's $69,000. Is this unfavorable or favorable? Whichever is the bigger number, that's what it is. So we see 115 favorable, 46 unfavorable. Overall, this was more favorable than it was unfavorable. So buying the cheaper strips worked for us because even though it cost us more in the usage of the strip, we ended up saving so much money from reducing the price that it overcame the unfavorable usage variance. So overall, this is favorable, and we should continue on with using the cheaper strips. Now, again, you can use the formula approach. You can memorize the formulas if you want to. I'm chill about that. You want to use the formula approach, go for it. But I prefer the diamond approach because it's very easy to think about it. It tells me by looking in the diamond exactly what's good or bad in both of them. And it's easier for me. So again, remember that in 10-10, we were asked to calculate the total direct material variance. Calculating the total direct material variance just means adding these two together. If they're both favorable, we add them together. If they're both unfavorable, we add them together. If one is favorable and one is unfavorable, we subtract them. And the larger number is the one where it determines whether it's overall favorable or unfavorable. Okay, so let's do the same thing right now with the direct labor. I still need all of my information here. So I'm going to copy this and I'm going to transfer it because this question says use the same information from exercise 10-10. So I'm still going to use the same information. I'm going to paste this. Now I've got all my information. Okay. So this time I'm doing the direct labor. They call it a rate variance, but this is the price per hour. So I'm going to put rate, but really this is the price variance. Okay. I love it when they say, oh no, this is a rate variance. They change the name. Why change the name? It's so much easier if we just use the same name over again. So this is the direct labor price variance, really. And this is the direct labor efficiency, which is how much labor are we using. So this is efficiency, which is basically the usage variance. So even though they call it different names in the textbook, we are doing the same thing. Again, we got the A over here moving over to the Z. So this is going to be my actual price, the rate that I pay per hour. This is my standard price, standard rate per hour. This is the actual quantity of hours. Guess what? We're going to do the same thing we did before. We're going to put in the shape. There we go. The actual quantity is going to be transferred up here. The standard price is going to be transferred down here. So I'm going to take the standard price here. I'm going to take the actual quantity right here. So what is the only thing I need here? Standard quantity. How do I calculate the standard quantity? We already know. It's the actual units produced multiplied by the standard quantity per unit. In this case, the standard quantity we're looking at is hours. It's hours. Let's paste this. Notice this is identical. We do not need to memorize different formulas. We're doing the same thing, but we're giving it different names in the textbook. I don't know why. It's just something that they do. So don't forget, this is the direct labor. So now I'm going to do the actual price. Actual price is $12.50. Standard price is $12. Actual quantity. This is the number of units we actually produced multiplied by the actual hours per unit. 78,200 hours. Don't forget, this is direct labor hours. And this is the actual. I'm going to take the actual and put it up here. Don't forget, this is direct labor hours. I'm going to take the standard price. I'm going to put it down here. Nice and easy. The only thing I need to calculate is the standard quantity. Remember how we do that? Actual output, actual units produced, multiplied by what? The standard quantity per unit, standard quantity of hours per unit. Standard quantity of hours is 0.75. There we go. I'm just going to center this so we can see it clearly. So now we can do this. 92,000 units multiplied by 0.75 direct labor hours. This is units. And there it is, 69,000. So we can now do the math. Actual price multiplied by the actual quantity. That's what it is. That's in dollars. Standard price multiplied by the actual quantity. We're going to take the difference. It's going to be the larger number minus the smaller number. Excellent. I'm going to go over here. I'm going to borrow this. I'm going to put it right here. Okay. Is this favorable or unfavorable? Favorable or unfavorable? This is what we actually spent per hour. This is what we should have spent per hour. It's unfavorable. Absolutely. And we can see why it's unfavorable, right? Because I should have spent $12 per hour and instead I spent $12.50. Maybe I got, more experienced people. I don't know. But I definitely spent more. Now, I'm going to go over here. I'm going to do the same thing. But I'm going to take actual quantity multiplied by the standard price. There's my number. Notice it's identical, but I still do it this way. I'm going to take the standard quantity for the actual output, and I'm going to multiply it by the $12. Now I'm going to take the difference. Okay, again, I'm going to borrow this. Here we go. And remember, this is direct labor hours. This is what I used in direct labor hours. This is what I should have used. So is this good for the company or bad for the company? This is bad for the company. This is unfavorable because I don't want to use more hours. More hours cost me more money. So this is unfavorable. Absolutely. So the direct labor efficiency variance, how efficiently we actually used the laborers that we had working for us, well, we weren't very efficient at all. We paid more for these people and they used more hours. This is a bad thing. They're both unfavorable. Sorry, I'm just going to change this to $1 so that we know that it's $1. Okay. We can now take this information and we can put it together. Unfavorable and unfavorable, remember we add them. So we're going to take these two and we're going to determine that these are unfavorable. So this is total direct labor variance is simply the efficiency variance plus the price variance. And we can see that this is unfavorable, $149,500. Remember in 10-10, we were asked what's the total variance for direct labor. We can calculate that by calculating the price variance and calculating the efficiency variance. Remember that inside the diamond is where it tells you whether it's good or bad for the company. And that will tell you whether it's unfavorable, bad for the company, or favorable, good for the company. Okay, so now I missed some questions. So let's just pop back over here. I'm going to make it larger so that we can see. Suppose the plant manager investigates the material variances and is told by the purchasing manager that the cheap source of leather strips had been discovered and that this is the reason for the favorable materials price variance. Quite pleased, the purchasing manager suggests that the materials price standard be updated to reflect the new, less expensive source of leather strips. Should the plant manager update the material price standard as suggested? Why or why not? And the answer is probably not yet. Let's see why. We can see that this is a favorable variance. We saved a whole bunch of money. Okay. And we did note that we used more, but we saved all this money. Okay. We saved 115,000. Now let's go over to the labor variance. We see that we hired more experienced people, but we used way more hours. In fact, the way more hours and the fact that we had to hire more expensive people, it cost us $149,000. We wasted $149,000. I want to be clear, we wasted $149,000. This may be because the purchasing manager bought cheap leather strips. And not only are we using more leather strips, but we're using way more hours of direct labor because they have to rework all these products. So when it says, should we immediately, the purchasing manager is like, yay, look at us. We saved $115,000. Yes, you did. But it cost us $46,000 in additional strips used. And then it cost us $149,000 more potentially for the labor. Until I investigate this unfavorable labor variance to find out, hey, why did we have to hire more expensive people? And why did those people work so many hours? I'm not going to immediately say, yes, let's update the standard, because I may have to punish the purchasing manager because they bought cheap goods and those cheap goods cost us a lot of money. Things don't stand by itself, right? If we buy cheap materials, raw materials, it has a cascading effect. It's not just affecting that price, it's affecting how much we use, and it's affecting our labor also. And so the answer here is no, we shouldn't. We need to look into the unfavorable direct labor variances to find out if it's connected to the fact that you bought cheap leather. So that's the answer there. Let's transfer over to this one. So this one was, let's go up here. Here we go. So this was the labor variances. As part of the investigation into the unfavorable variances, the plant manager interviews the production manager. The production manager complains strongly about the quality of the leather strips. Are we surprised about this? No. He indicates that the strips were of lower quality than usual, so workers had to be more careful to avoid a belt with cracks, and more time is required. Also, even with extra care, many belts had to be discarded and new ones produced to replace the rejects. This replacement work has also produced some overtime demands. What corrective action should the plant manager take? Well, we already know what corrective action he should take. He's got to go back to the purchasing manager and say, look, your $115,000 of savings on these strips has cost us a lot of money and a lot of grief. And as a consequence, you're going to have to find better quality goods. And most likely, you're not going to have a positive variance. We'd like you to buy something for $4 because your buying cheap strips has had a cascading and negative effect for the company overall. All right. Keep in mind exactly how to calculate this. Again, you don't need to use the diamond approach, but I highly recommend it rather than trying to memorize a whole bunch of formulas, which the formula approach and the column approach that's in the textbook, both of them require you to memorize a whole bunch of stuff. I suggest you use this so you don't have to memorize stuff.